Would you kind of walk us through now what the relationship between return on invested capital, buybacks, and dividends actually are in this instance here?
Yeah, so the better the return on invested capital, the more you would want management to actually keep that money and reinvest into the business. So with that's just above the market average rate of return. And so that's not fairly compelling for me to then say, oh, please keep my money and reinvest it. And when I see a very low return on invested capital, um, well, actually, I'll say it depends on the business too. But with a lot of businesses, typically, if I see a low return on invested capital, I would prefer them to return more capital to shareholders. Then I'll go somewhere else and put the capital to work. But this one, I mean, they're doing the right thing. That they're buying back shares, they're paying you a dividend. They're probably going to be growing that dividend. The payout ratio is, fairly low. Plenty of room to grow the dividend. If you're a dividend investor, those are some of the things you probably look for. However, be warned, this is still kind of a technology play. So if they don't keep up to date with the technology trends, they will suffer. And again, they're utilizing more debt than they are utilizing shares to fund themselves. That's what that means, debt heavy. Debt heavy just means they use more debt than shares. And in this case, they have negative share usage because they buy back shares, but they do have some debt. So obviously the model is telling us debt heavy.
And now kind of going into exactly sort of the capital structure that we're looking at here, would you kind of elaborate on the relationship that Coker, the COCR cost of capital, realized, as well as what alternative weighted average cost of capital is for the audience here today?
Well, you mean the alternate?
Yeah.
Okay, so the alternate weighted average cost of capital utilizes a completely different formula. I mean, even the estimated WACC is sort of a different formula because the Coker is taking into account. I said it would be a different video, but I'll touch it here. So Coker is actually the realized cost of capital, which is actually what they're actually doing, not the estimated options, right, that they have. So for example, weighted average cost of capital takes into account the cost of the equity and the cost of the debt, but they may not be using one or the other. They may just be using one of them and not using any of the equity as a theoretical cost. That's kind of what the problems are with WACC. If you look up, some of the problems with WACC, that's right there is one of the problems with WACC. WACC is pretty good.
This is sort of your solution to WACC in this instance, if I'm understanding this correctly.
Yeah. It's kind of like looking. It analyzes the business. It's like again, it's not end all be all. It's like a flagpole to kind of see, okay, what's going on underneath the hood. What is management doing? And the Coker, I'm pretty sure it doesn't exist in the internet. You look up Coker and it doesn't exist. Do it right now, Austin. Tell me if you find Coker.
I will. Yeah, I will.
I'll be surprised because anyway. So basically it takes into account the actual doesn't exist. Yeah.
Nope.
So, yeah, of course. So it takes into account what management actually utilizes in terms of the cost of whatever they're using to fund the business. And so if they're not using shares, why would we compare it to the cost of equity instead? But alternate WACC will take the traditional formula of WACC, but then just calculate the cost of equity in a slightly different way. And then on the final product, when we release it on our website, it's and it's not the current website, it'll be a new website launch. There's going to be an even more complex one. Of course, I don't want to overwhelm everyone. So these will be like off to the side in like advanced menus. So if you don't even want to look at this stuff, you don't have to. These are just tools that will help you in further making more informed decisions if you so choose. And then we will hopefully do good enough job through videos at explaining what each one means, and then how you may utilize these tools, because they are tools at the end of the day. They're not going to do the work for you. They're just going to help guide you in the thought process. But alternate WACC takes into account, for example, beta and the correlation with the broader market, stuff like that. So not to bore everyone with math, but the alternate WACC is WACC with a little different flavor to it. And even the estimated WACC, there's a little different flavor to it, but that's why I put estimated with an asterisk. Anyone can do the WACC formula. You go on an Investopedia and you can do the WACC yourself. It's not too difficult. Dilution accretion doesn't really serve well for this. I would use dilution accretion for businesses that are diluting you. So in a business that's not diluting you, ignore it. Okay.